Is Eternum Health a visionary biotech play or a cash-starved shell? The latest 10Q filing for Eternum Health reveals a company in the midst of a total identity shift. They are exiting the EV sector entirely to enter the longevity and anti-aging market. At the heart of this is a merger with Eternum Health LC. This isn't just a name change, it's a fundamental asset swap designed to replace dormant revenue with a high-margin therapeutic pipeline. The strategic win here is the acquisition of peptide-based intellectual property. Unlike many biotechs, AETN claims to have a commercialization engine ready to deploy, bypassing years of R&D. From a shareholder perspective, the most compelling metric is the potential for deflationary equity. The outgoing founder has committed to canceling up to 13 million shares, with roughly 52 million shares outstanding. A 13 million share cancellation represents a 25% reduction in supply. This creates a scarcity narrative that could drive a significant re-rating. Furthermore, the company has secured 51% voting control and super voting preferred shares, ensuring the new healthcare strategy is locked in and immune to outside interference. But we must look at the bear case, and the numbers here are sobering. The Q1 2026 statements show revenue has effectively evaporated, plummeting to just $2,260. This is a 98.6% collapse year over year. More concerning is the gross loss of nearly $12,000, proving the legacy business is completely dead. Operating expenses are still climbing, driven by officer salaries and professional fees, leading to a net loss of nearly $140,000 for the quarter. The liquidity situation is critical. The company reports only $19,000 in cash on hand, while facing current liabilities exceeding $1.2 billion. This creates a massive liquidity cliff. While the merger promises a $1.5 million cash contribution, that money is not yet reflected on the balance sheet. Skeptics will also point to the longevity assets. The only intangible listed is $15,000 of capitalized software. Is that enough to build a biotech empire? Additionally, the share cancellations are conditional and have not yet materialized, while the authorized share count was increased to 250 million, potentially offsetting any scarcity. The company is also burdened by millions in related party promissory notes, which often signal complex internal debt structures that can complicate a turnaround. So where does this leave the investor? AETN is no longer an infrastructure play, it is a speculative bet on a corporate rebirth. If the merger closes and the cash arrives, the peptide IP could trigger a massive re-rating. But if the liquidity crisis hits first, the longevity dream may never materialize. Ultimately, Eternum is racing against its own cash burn to prove that its new thesis is more than just a rebranding exercise.